Good morning, everyone. It's Friday. Thank God it's Friday, and
Yeah.
we've had an active week. Yesterday was pretty green. I don't know how your stocks did, Daryl. A couple were red, but most everything was green. First, how you doing this morning, and how did you do yesterday?
I'm doing wonderful. And yesterday, I think, was my best single day ever.
All right, congratulations. Nicely
Yeah.
done. Yeah, the heat map that I'm showing for the one day, it has a lot of green on it across the board. I think every sector had some stocks go up except for energy. Energy was kind of not doing much, but everything else kind of was working. And that is a little different. The last probably 2 weeks, it's been kind of a mixed heat map where you have some stocks that really went up and some stocks that really went down. So it was a matter of picking the right stocks. And so far, September, knock on wood, we haven't had a harsh sell-off of any type. It's just been, uh, like I was saying, you have to be in the right stocks to get performance in September, or potentially you're not having good days because some of your stocks are going down. Um, but yesterday was a pretty good one. Oracle was down, but geez, the day before it was up 36%. Broadcom was down 2.69, but the day before it was up like 9%. So, yeah, they got to give back some of those gains, and everything else was good. So, we're finishing off the week. We don't have any big earnings today. We did have one earnings report yesterday in Adobe. We can talk about that later. But to kind of get started, I know there's a couple of stocks that you wanted to look at, and then there's about four stocks that I want to look at. And we can start with your list and then see if there's any requests along the way. If anybody that's viewing would like to request and you're a member, just put it in the chat. If you're not a paid member, just a $5 super chat, and then we can analyze a company of your choice. And Daryl, you want to talk about either Warner Brothers or Lyft?
Um, yeah, I almost hate to admit that I'm a shareholder in Warner Brothers, but I received those shares as a spinoff when AT&T spun off WBD. And part of my strategy there, I thought they would do better, and they actually did. There was a point in 2021 where they went up 263% in less than probably about 5 months.
How
So
much was that?
it was 270,
Jeez.
263% approximately in about, in just from November of 2020 to March of 2021. That was a three bagger over that time. So then you can see what they've done since then. But anyway, I got these shares, and then they lost big. I sold some and decided just to hold on to the rest. And then in 2022, I did a Roth conversion, so I converted that over to a Roth, paid taxes on the lower amount. So from a tax perspective, that was somewhat of a good move. And then I just held them there because I created the Roth that year, so I can't touch that money for 5 years other than the capital that I put into it. I can't pull out gains tax free for 5 years. And then in 2023, I did a subsequent Roth conversion with a few other stocks. So that money in 2023, I can't touch for 5 years. So anyway, I just thought I would let it ride in there. So anyway, let's look and see what happened just yesterday. Is they were up 28% and as high as about 33% during the day. And this was on a rumor, somewhat of a confirmed rumor, that Paramount Skyworks was going to make an offer on Warner Brothers. And let me point out that Warner Brothers, about a month or two ago, announced that they were going to split into two separate companies. So anyway, Paramount Skyworks is going to put an offer on the entire company. And with that happening, there were other companies that might have been interested in only half of the Warner Brothers business. So when they split off, there could have been a buyout. So next year sometime.
Let me guess. Everybody wants the half that has Bugs Bunny.
Yes.
Perfect.
Yep. So, and there is a lot of content that Warner Brother has control over. The streaming, I don't think is probably ever going to be a good business again. I just don't know. But anyway, there's talk that there are going to be other companies that may jump into the fray here because they don't want to lose that opportunity to have that studio business. So anyway, I'll just leave that right there. But yesterday was one of the best days in probably 5 years for Warner Brothers Discovery.
Nice. So that's what's I think you said you had a really good day yesterday, and this is probably one of the reasons, right?
Yeah, in fact, when I did those Roth conversions, they were worth the stock was worth about $26,000 more than what it was worth at the time of the conversion. So I only paid tax on the lower amount, which from a tax planning was a good move, I think. And because I was going to let it sit there for 5 years, I didn't have any need for that particular chunk of funds. And I would just let it sit there for the most part. I have traded some in there, but not nearly as much as some of my other accounts. So anyway, yesterday was the first day that account from those transactions have completely recovered. So I don't ever have to pay taxes on that again. So that's it's kind of wonderful news and pretty exciting milestone yesterday. So the other one I had was Lyft, and the only reason I point this one out is they've been doing pretty well here over the last few weeks or so. They're up. They were up about 21% on the previous day's close. Yesterday they printed a bearish reversal pattern. So I think we're going to see some pressure, downward pressure on Lyft over the short term. And if I look back at some of these other candles, this is a reversal pattern. It only reversed for a day or two and then jumped up. Here is a reversal pattern, and it went down for about 5 days and then broke out above that again. Here we had these two aren't really reversals, but then we printed a very large upper tail yesterday, and then yesterday we got a bearish reversal pattern, bearish candle here. So anyway, that's the only reason I point that one out. If anybody's chasing Lyft or you're looking at getting into Lyft, you can probably wait a day or two maybe and pick up a pretty good price to continue with this uptrend, overall uptrend.
Yeah, and Lyft, I continue to think is like an acquisition target. If one of these companies that especially wants to be a robo taxi company, they could potentially buy a Lyft, and you get this big customer base.
Yep.
And that would be a good thing for
Yeah, I keep thinking the
investors.
same thing. So I have a small position in it, 100 shares or so, and I'm just going to hang on to those.
Perfect. Well, I could go over my fundamental analysis of Warner Brothers and Lyft, and I've got that ready.
Okay.
So before I jump into Warner Brothers, Paul, gotcha. Looks like you want to look at Freshworks. Yeah, we can look at that. Good morning, by the way, and good morning, Shadow Guy. Okay. Um, so Warner Brothers, they've been kind of caught a little bit in no man's land. They legendary company, so many good movies, Bugs Bunny, a lot of cartoons, and their content, like you were saying, you know, is worth a lot because if you flip on, Netflix or, any kind of streaming service, their libraries to some extent are limited. And Warner Brothers has been making movies for literally 100 years. So you got movies from 30s, 40s, 50s, 60s, all the way up to modern time. And that's a pretty strong library. So the library itself has a lot of value, but they just couldn't get into like the streaming biz. The previous ways that we consumed media were quite favorable for them in the movie theater, and then DVD and video were pretty good days for them. But the streaming days just kind of changed the game. And I think that things like YouTube will also continue to make it harder on Warner Brothers and the traditional studios. I think because the consumer is kind of changing, right? Um, I notice it in my own behavior and just about everybody's behavior. Uh, 25 years ago, we were kind of programmed to be, if you're watching TV, you're going to watch for 30 minutes or an hour. If you're going to watch a movie, you're going to watch for like, I don't know, 2 hours. The Godfather, I think, was 3 hours and it was very successful. Well, nowadays it's like, geez, you got TikTok, less than 1 minute videos. Everybody's like, you compress your expectation for media is so different now. You can watch so many things. You could go watch 3 minutes here, 5 minutes there, a couple minutes here, and get what you're looking for very quickly. And I don't know that that's going to change. I think it's just going to get better and better and better. But we'll see how Warner Brother adapts, and it's good to see that they are held with some regard and are driving up their stock price. And one more comment on the environment for acquisitions is much better. Um, I think it's Skydance bought Paramount, and they're kind of going through the whole integration of that business, and now they're setting their sights for Warner Brothers, and maybe some other bidders will come out of the woodwork. So acquisitions are going to be more active. Uh, Acquisitions, mergers, that kind of thing. IPOs. I think there's going to be an IPO today. So that environment is changing, which is very good. The previous 4 years, the Department of Justice was like, oh man, all corporations are terrible and they're trying to acquire businesses so they can really punish consumers. I'm not in that boat, but I'm not going to start a debate around that. I'm just going to point to the fact that mergers and acquisitions are going to be more active. I think they're going to be good because companies like Warner Brothers, they're getting run over by the new paradigm, which is streaming, which is YouTube, TikTok. I mean, the consumer's changing and they have to adapt. They have to have a way of getting their media in front of people that want to watch it. Aside from that, this is a relatively small cap, market cap 40 billion, even after the run up yesterday. So it was quite low. It was quite low for a while. And it is a pretty amazing chart, right? And what caused this big spike back in 2021? Was it a short squeeze or what caused that big rise?
Yeah, I think it was a little bit of meme media and a short squeeze.
Incredible.
I wish I would have sold it all about right there, but I did not.
Incredible. I had a couple of stocks do this and I sold them both.
Yeah, I wish I would have done that.
Because if I can't explain it and I'm sitting there with a big gain, I get out. So 40%, $40 billion market cap, revenue of 38 billion, PE this year is 52, and price target, analysts think it's a little expensive now with the big run up on the stock. The revenues for the company have been declining. So the overall business is not booming. It doesn't have momentum. They do drive free cash flow of 4 billion. Looks good. Gross margins look okay. In the past, they used to be better. They used to be in the mid 60s. Now they're in the mid 40s. This I could probably say is because you are not selling DVDs anymore. You're
Yeah.
you're not renting videos anymore. Those days are long gone. You're now having to compete with some creator on TikTok on an island that is getting a lot of eyeballs. So I think that's a measure of how much tougher it is in their business. They are slightly profitable, although they've been very unprofitable, and they're expected to be unprofitable next year and the year after. So that's where they land there. They have 15 analysts covering them, and they all expect the company is going to grow a little bit. So that's good. Or consensus is that they're going to grow a bit, but they are going to be unprofitable for a couple years. And this acquisition is very timely. If they can merge with another company, that'd be great. One thing about them is they do carry some debt,
Yeah.
$34.6 billion of debt. So
They
they
were
do have to,
saddled with some debt when the spinoff from AT&T.
yeah. So when I look at them from a valuation perspective, I'm only going to look at um, their cash because I can't look at earnings per share because they're not going to have any positive earnings per share over the next 2 years. And they're not growing. So I'm not going to grow the first 4 years of cash. And the reason I don't grow them at all is because if you look at the last 3 years, it was actually a declining free cash flow rate. So I'm like, okay, I'm not going to decline it, but I'm just going to say they're going to hold steady.
Mhm.
And when I do that, I get to a net present value of $68 billion for the cash, discounted by 9%, which is higher than a very good balance sheet company that's in an industry that's, is having better days would probably be at a 7.5 or an 8, but this one's at a 9 because of the debt. And cash is 4.9 billion, debt is 34.6. So equity value is 38.4. So right now the company is, I would say, fairly priced, maybe priced at a 4% premium. Now the acquirer is going to have to pay to buy the company. So they're going to probably have to pay a little more than intrinsic value. And because Warner Brothers can negotiate, especially if there's other bidders. So this stock is it's priced fairly, and I'm glad that they're going to be acquired. Hopefully, um, it's a good thing for Warner Brothers. They still have a lot of assets in California and Hollywood. Like they have one of the biggest lots in Los Angeles, and they I don't know if they lease it out, rent it out to a lot of other companies to use to make movies. So they are somewhat of they are a media company, but they're also kind of a real estate company that they rent out their studios. So that's interesting about them as well. So that's Warner Brothers. And the second stock that you talked about was Lyft. And Lyft is really it's valuable. It's 45% discounted because the stock's just been so sold off. The stock price is so low. And when I measure their free cash flow forecast and discount that forecast by a 10% discount rate, because I think they're riskier, they kind of are losing the overall war against Uber and may not be as relevant as they would like to be in the future. But their value of their cash flow is 15 billion, and add cash, take away debt. Their market cap's really low, so I think they're a really good acquisition target. Another business can, snatch them up. It's profitable, generates a lot of cash. If it's strategically aligned with that business, the business that that is acquiring Lyft, it'd be a win-win. So looks good from that perspective. Earnings per share drives a discount of 14%. So overall, Lyft is a discounted stock. I don't own it because I own Uber, and I think that Lyft isn't a good idea, um, especially if one's playing the chances of it getting acquired. I think if it gets acquired, boom, you just made 30, 40, 50% overnight. So that's Lyft. And good morning, Carlos. Hopefully you're having a nice day. So Paul wanted to take a look at Fresh. Let's take a look at Fresh. So Freshworks. Freshworks, a software development company, provides software as a service products in North America, Europe, Middle East, Africa, Asia, internationally. The company's software as a service solutions includes customer experience, employee experience. Customer experience products include Freshdesk, a ticketing and case management solution. Okay. So these guys are similar to ServiceNow. ServiceNow started in IT doing ticketing, and now they're really strong in overall service. I've never heard of Freshworks. Looks like all these companies are using their solution. Okay. So they have, okay. Okay, good. So they started, it looks like they can do help desk, right? Everybody's had an IT issue. You open a ticket, and then these guys will help you out. So that makes sense. I like software businesses. Let's take a look at it closely. I'll do a valuation on Freshworks. While I do that, let me say hello to Ben 10. Good morning. Thanks for becoming a member. It's been great to see your name for a while. And then Paul. Yeah, so let's take a look at their fundamentals. All right, so $3.76 billion market cap, nice and small. Revenues, $782 million. They're losing some money, not a showstopper. Shares outstanding, 291 million. Forward P looks good. They're going to be profitable. Analysts think they're very discounted. So these guys may be taking their lead. The biggest company in this micro industry is Salesforce, and CRM stock has been sold off, and even ServiceNow stock has been sold off. So those are two big players, and the market may be putting Freshworks along with that group and saying, well, these stocks are not desirable, so we're going to sell them off. Okay, that might be an opportunity for an investor because, they're kind of guilty by association, but maybe their fundamentals are way better than the stock price would suggest. All right, growth. Growth is good. It's not great, but it's good. I'm saying it's not great because they're relatively small and their growth rate is just good, 20%. At this size, if they were growing at 50, 60%, then I'd say sales growth looks great. Or if they were like 20 billion in size and they were growing at 20%, that would be great in my ranking. But that's good. Let's take a look at other fundamentals. I'm expecting to have good margins because they're a software company. They have 84% margins. So absolutely very good margins. And as they get bigger, they're going to fill in these negative numbers with positive numbers, big positive numbers in the future if they can continue to grow. They double their size, they're going to really start cranking out profit. For now, they're cranking out free cash flow. I like how free cash flow is growing over time. They're making more free cash flow. So that looks good. So free cash flow is at 192 million 460,000. So that looks good. Let's see if they have any debt on their balance sheet. I'm going to guess that they don't, and they don't. They have a good amount of cash at 926 million and only 36 million of debt. So that looks good. What are analysts thinking about this company? 15 cover it. It's a small cap, but it's getting good coverage. They're saying this stock market is not paying attention. This stock is discounted by 56%. Okay. All right. And looking at their earnings per share, they're going to be profitable this year, and they're going to be profitable next year and grow their profits nicely. Revenue is supposed to grow in the mid-teens. Again, I think that's good, but it's not great. I'm not like excited, like, whoa, they're going to be a $5 billion company in the next, 4 or 5 years. Nope. I think they're going to be a good small business. Maybe an acquisition target, maybe not. Depends. So I'm going to use this to kind of say they're going to grow free cash flows by probably 11, 12%. All right. And then there's one more number that I need, and that is their shares outstanding, 291 million shares outstanding. Would you like to show some charts while I work on my evaluation on
Sure.
Freshworks?
Sure.
Thank you.
It looks like they IPO'd in 2021, where they were trading at a high of about 53. And since that time, it's been pretty much downhill. The one thing I see when I look at this chart from where the price is today is there seems to be good support at around 1050 to 1080. It hasn't been below that price over the last 3 or 4 years. So you have about $2 worth of risk there. And if they did get back to this 19, there's $7 of upside. So your reward is 7 and your risk is 2. So that's somewhat of good news. If I bring this down to maybe just 1 year, they have been on a decline, as we can see, for quite some time. It would be nice to see them break out above this magenta trend line, downtrend line that I put on the screen. So it'd be nice to see them break above and hold that price. If they can't do that, then they might be floundering here for a while. Was a big volume day yesterday for whatever reason. The price didn't seem to move all that much, but the volume was at least double yesterday. I don't know what happened yesterday. Their RSI is below the midpoint of 50 and looks to be declining. The PPO has been under the midpoint since the 11th of July. Looks like maybe they were going to cross above that midpoint, but then started declining again. Their relative strength and relative momentum as compared to the S&P 500 they're just about even. Accumulation has been on a decline since 13th of June or so. Their money flow is negative at the moment. Their 1 year performance compared to the SPX, they're underperforming the S&P. They're underperforming the technology sector by 8. They're underperforming software, and the software group is outperforming. So on a relative basis, they're definitely not performing as well as their peers. The 7-2 reward to risk uh, is a positive for me. If you follow this company and something you're interested in.
Okay. So in conclusion, what's your best guess as, what's this stock going to do over the next 6 to 9 months?
That's a good question. It does have to break above that trend line. I wouldn't
Mhm.
I wouldn't be comfortable with it appreciating until it breaks above that down, because it's in a confirmed downtrend at the moment.
Your comments kind of are aligned with what the market's been doing to software companies.
Yep.
It just doesn't like software companies. And an example of that is Adobe had very good earnings. They were trading higher in the aftermarket. And right now they were in the red. Now they're slightly in the green. It's like, man, what does the software industry have to do? Like high margins, high cash flow, high profits, high growth. It's like, we don't care. You're not, you're not Nvidia making semiconductors, so we don't like you.
Right.
Very good. Thank you, sir. Let me get to my valuation and uh, Amandio, thanks so much for the super chat. I'm going to get to your super chat in a few minutes. I'm just going to finish my analysis on Fresh. So Fresh, I was able to take ServiceNow as just, kind of the template. And overall, when I put their cash flows in a forecast and grow them by 12% and then long-term growth by 5% because they're so little, I get a very nice valuation for the company. It's 52% discounted. And their earnings per share also provides a nice discount at a PE of 25. They are growing at 20%. They deserve a 25, and they're going to keep growing their earnings per share by more than 10%. So this is a discounted stock. It looks good. Now, software stocks. I've got a long list of software stocks. I am invested, and I don't know when it's going to start to work, but it's going to work. It has to, because these companies are just too profitable. You have right now, Wall Street is really gets it really gets going on stories. And the story around software is, well, AI may change the way people use software, may eliminate some software companies. And I think some of that is some partially of it is true, but I don't think it's going to be disruptive like some people would say. And I think companies like Freshworks are going to continue to operate and be really, really profitable. And at some point, the market will buy them up. So Freshworks for me is a buy and a good idea. I like their size, really small, and software companies can grow without much capital. It's like, you don't have to build a giant factory to keep developing your source code. You can just keep growing your product, making it better for your customers, and you're off to the races. So, thanks for asking about Freshworks. One new little small cap that is really interesting. Appreciate it. All right, we got a lot of people on the stream. Thanks everybody for joining, and we've got some comments I got to catch up on. So for algorithm, good to see you. And then Andre Duranti, thanks for joining. So ACM, so Andre, never heard of that small cap. I can look at it if you want to buy a $5 super chat or become a member. And then Big House, good to see you. Big House Juice. All right, so we're going to go over TDD or TTD, excuse me. And Paul, you're welcome. All right, let's get into TTD. Hopefully I get the name right. It's early where I live. So TTD, Trade Desk. So this stock's kind of been not not doing great. And not doing great 5 year, not doing great 1 year. And while other stocks in their business, okay, this is a company that offers self-service cloud-based ad buying platform. Okay. So the big player in ad tech is AppLovin. And other players include Viant and others. Okay. AppLovin is doing so well. They're growing like at 70%. They're the biggest one. They got added to the S&P. Just a lot of good stuff happening up there. So let's take a look at Trade Desk and see if maybe the market just doesn't understand them, is not treating them rationally. Market cap 22 billion, revenue 2.68 billion. All right. They are turning a profit, and analysts think it's really discounted by 102. Okay. Let's take a look at their financials. All right. So, one thing that immediately I look at is this would lead me to believe fundamentally I should be seeing declining sales, declining revenue. I should be seeing a problem in their financials. Okay. So, that's the first order of business is this rational? Is this big sell off at 55% based on fundamental decay, a fundamental problem with the business? They're growing. So, all right, stock market, what's the deal? Now, they did have a very bad quarter, not a very bad quarter, I would say a disappointing quarter if you're going from mid 20% growth to 18.7. I think they did have an earnings report where they had some disappointments in it. So maybe you have reason to sell off the stock a little bit, but not for as long as it's been selling off. It's still overall a very good growing business at 23% for the trailing 12 months. That's good growth. 2.67. We just looked at another software company in Freshworks, and I was saying, well, they're less than $1 billion growing at less than 20%. And I was like, that's good growth. This one's a little better than good, but not great. It's like bigger, growing better. So it's very good. So free cash flow looks very good. Very, very good. Okay, that looks good. Margins, very good. This is a high margin business. This is software. You write the code, sell it to as many customers as you can because it doesn't cost much. So the rule of 40 for software companies, you add the profit margin 15.5 plus your growth, which is 23.18, and you get roughly about 39. And that's, if you get to 40, 40 represents a good software company. It's a good investment is kind of a general theme. This one's really close to that metric, close enough for me to say this is a good situation. Let's take a look at their balance sheet and make sure that these guys aren't sitting on a ton of debt. And they're not. They have $1.69 billion of cash, $343 million of debt. So this balance sheet's good. They can pay off debt very quickly. They write a check to be a big check. I don't know if they'd have room for all those zeros, but they could write one check. All right, so we went over balance sheet. Let's see how many analysts are covering them. Man, 34 analysts are covering it. And some analysts are like, market's crazy. This is a really valuable business. And the worst price target is, hey, these guys can go up a little bit. So the whole community is like, this is a discounted stock. So interesting. All right, so we have a business. This is their year that they're operating in. And I think this is kind of inaccurate because they're going to grow faster than that. They've already have quarters where they've grown in the 20s. But in the future, they're going to grow high teens. That's very good. Okay. and they're going to expand their profitability. They're going to be a $4.6 billion revenue company in 3 years. And their PE is dropping because their profitability is expanding. So these numbers look really good. Okay. All right. So let me make a note of a few things while, and you know what? Could you show some charts on the trade desk and then I'll do a valuation?
Sure.
Thank you.
So I'm looking at the 5-year daily price chart to start, and it looks like they're getting close to support levels they had in 2023 and 2022, which was around $43 per share. They're trading at 45 right now. So given the fundamentals, you have risk of, looks to be about $3 or so, and a lot more reward potential if they can do some recovery. I'm going to step down to just 1 year. Let me change this annotation of the Fibonacci retracement. They would have some work to do to recover those. So shadow guy, if you're on and you wonder if I use Fibonacci, here you go. Okay, so they were at a high of about 140. So that'd be the 100% mark. And they've hit this low a couple of times here, just even this year. And they're currently actually slightly below that level, it looks like. So they've got some work to do. They do have a declining 200-day, 50-day, and 20-day. None of that really bodes well for momentum. They are in a confirmed downtrend. It looks like they took a big hit in February, and I don't follow this company, so this could have been earnings related or maybe something else. And they hit the COVID lows at 42, and they recovered back up to 91, so almost doubled in a few months, and now they're right back to where they were in April. Their RSI is extremely oversold at the moment. They're below 30, currently sitting at 25. Their PPO is negative. Their momentum actually is higher than that of the S&P 500. Their relative strength is below that. They're at a 52-week low for accumulation, so there's been a lot of distribution since February when they were at their high. Money flow has been negative for most of the year. They had positive money flow in May and first week of June or so. They're underperforming the S&P 500, underperforming the technology sector, underperforming the software group, and the software group is slightly outperforming the S&P 500. They've got some work to do.
Yeah. And I've got something to share. Give me a second here. I am putting the finishing touches on a couple things. Okay, so I've got a valuation for Trade Desk as well as some of their competitors. So the Trade Desk is discounted by 34%. They have really good free cash flows. So their free cash flow forecast looks really good. And their intrinsic value is good. Balance sheet's great. Discounted by 35%. On earnings per share, discounted by 31%. So this is a nice discount on this business. If you think their business is going to grow and even outperform what analysts are expecting, this is a really good idea. But you got to study the situation because they did have a fall in the revenue growth rate, that does worry me. I need to understand what's going on because it seems like AppLovin is outperforming, outmaneuvering its competitors, and it's the biggest one. So Trade Desk is discounted and would be a stock that I would entertain. I own Zeta. They're a competitor. They're discounted at 33%. They had a really good day yesterday. And I own AppLovin. AppLovin is fairly priced. AppLovin is bigger. I think substantially bigger, and it really just grabbed the attention of the market. They've done really well. When we look at a comparison between Trade Desk, AppLovin, Zeta, Viant, AppLovin is just eating a lot of the appreciation away from everybody else over the 1 year. It's up 455% while the other companies are struggling. Now, is that dominance going to be like Meta, kind of outperforming everybody in social apps? Is it going to be like Google, just did it so much better than all other search engines were pretty much irrelevant? I don't know. I don't think we could go that far because maybe AppLovin's great for particular industries to do ad tech, but maybe Trade Desk is really good for, 3, 4 different industries, and they can really grow within that specialization. I'd have to study it and see, well, what's going to make Zeta successful? But Zeta did have a very good day yesterday. Let's look at the 5-day. Yeah, Zeta's had a good 5-day. AppLovin's had a good 5-day. But the others, Trade Desk is just getting smashed. Now, I would say on Trade Desk, let me get rid of this, and this, that we see that they're declining sales, right? This is rational. Okay, you had a decline in sales growth. So some of this is kind of, it's rational. Like, hey, you can't have a business that's losing to AppLovin and expect that business is going to be very competitive and good in the future. That makes sense. I'd have to explain that before I'd ever become an investor of Trade Desk. I have to know, are these guys going to be much bigger in the future? Or are they going to be less relevant? If they're going to be less relevant, I'm going to stay away. No, I know who's winning the war, and that's AppLovin. I think Zeta's growing well and not getting disrupted by AppLovin as much. So I'm going to bet on Zeta and AppLovin. But that's the analysis on Trade Desk. Thanks for asking. Appreciate it. Hopefully you found that interesting. Thank you, sir. All right, the comments are coming in fast. Feel like a short order cook outside of a football stadium, and the football game just ended. Okay, Big House. Do you think the market wants to see these software companies boost revenues with AI? Yes. And I think the market's in this wait and see mode. And part of like what's been promised, or I should say that's been discussed, is, oh, AI is going to do all these awesome things, like these incredible things. I would say that maybe in about 20, 30 years, all that's going to happen. Between now and then, businesses have to run. They have to, Warner Brothers has to keep making movies. Automotive companies still have to make cars. Chipotle still has to make burritos. Industries have to continue to operate, and software companies will continue to sell very well into these businesses that are doing really well. They're like, if they're buying, we looked at Freshworks, right? You have like the mortgage industry is about to take off. I think Daryl on Wednesday covered Rocket Mortgage and how lower interest rates are going to create a boost for Rocket. And well, they're going to need more people, and those people are probably going to have IT problems. They're going to be like, oh, I have an IT issue. Well, we need to buy more license of Freshworks, because businesses like Rocket Yeah, AI is interesting to them too, but they have to keep up with the demand for mortgage applications, and that's really picking up. So I think AI is the topic that is everywhere, but fundamentally, I'm more focused on top line revenue growth. Like Adobe had really good AI innovations in their product. They're growing really well. And I don't know what the market's doing to Adobe today. And look at that. It's down 1%. It's like amazing. This is a company that's like been around for a long time, dominant in their market, but the market just is not excited about software. And if you saw like when Daryl looked at the chart for, I don't know if it was Freshworks or I think it was Freshworks. That software kind of the undesirable feeling of the market for software is showing up. This is almost tracking exactly as Freshworks is tracking, while the company keeps growing. Big top line revenue growing at 11%. Really good growth. So yeah, I think the market is irrational when it comes in general when it comes to software companies. For algorithm DCA, yeah, I think I answered that question. Braden, good to see you. Thank you. Appreciate it. And Adobe, yeah, Adobe, crazy. I said that yesterday. That Adobe's always surprised me. I didn't even want to guess. All right, so we're going to handle another super chat. Thanks, Andre. We're going to look into ACM Research. So ACM Research. I think this is the one. So ACM Research, together with its subsidiaries, develops, manufactures, sells capital equipment worldwide. It also develops, manufactures, and sells a range of packaging tools for wafer assembly packaging customers. Okay. Wet cleaning equipment, front end production, processing. So these guys are in the semiconductor ecosystem. Here's their big machine. Okay. Got it. Okay. So they're in the semiconductor ecosystem. They're a small cap, 1.96. Where are they located? So they are semiconductor. They're in Fremont. Okay. So less than $2 billion in market cap, revenues of 815 million, net income of 112 million. PE ratios are really low. High beta. Okay. And they're priced a little expensively, according to analysts. Year to date, up 100%. 1 year, 83. And then the 5 year, not so much. It looks like they had a price that really was run up in 21, came down along with everybody else in 22, and it's been making its way back. So it's had a good run ever since hitting its low in 2022. And again, in 2022, everybody was getting their stock price sold off. So this is catching my attention. We're going from 40 to 17. What's going on? So you see how we're going 40, 21, 31, 13, 6. Okay, that's not good. Now they had a big quarter, and that's the compare is very difficult because they grew last year. Man, I guess their machines are big, right? So if you sell more units in a particular quarter, it's going to create a big number, and then it's hard to compare it to the following year. But This is a concerning number, 6%. Okay. So their growth is declining, and they're still relatively small. They're only $815 million. Take a look at their profitability and free cash flows. So free cash flow isn't consistent, and it's not positive at this time. Last year was at 69 million. This year it's gone into the negative. Their gross margins are just shy of 50%, and they are profitable. Okay. And I'm going to look at their statement of cash flow just to get a little more detail. Here's the cash from operations. It is positive for the full year last year. It's positive for the trailing 12 months. But this CapEx, so they have to make these big machines. And when you're making stuff, oftentimes you have to put a lot of capital back into your factories to retool, to improve the tool set that your employees are using to build these machines. And that takes away capital, right? A perfect business is they sell their product, keep a lot of it as profit, a lot of what the revenue they received, they kept it in the form of profit, and they kept it in the form of cash. They can put that cash on the balance sheet, buy back shares, acquire other businesses, create more value for this company. And businesses like these that have factories have to put a lot of that capital back into the business, which is a necessity. But in my book, it makes them less desirable because you're having to, in a way, rebuy the business through your capital expense just to keep the business operating. Now they are growing a little bit, so I'll cut them a little slack that, yeah, we got to put in capital if you're going to be growing. Got it. But you saw that they had a decline in sales. So that is one desire aspect of this business. Only two analysts cover it. And they're not in agreement. One's at 36, one's at 18. See if more analysts are looking at their consensus forecast. 10 of them are looking at 26. They're going to grow mid-teens, 16%. They're going to grow in the teens. That's good. If we believe this forecast, and I don't see why they wouldn't grow at this rate, because semiconductors are going to be in demand forever. I think they'll probably hit this forecast and be a $1.5 billion market cap or revenue company in 2028. And the revenues are going to expand nicely. All right. Could you take a look at this stock and look at the charts, and then I'll create a valuation?
Sure.
Thank you.
So I'm going to start out looking at 2 years because I see several tops here. I see one in March of 2024, April of 2024, then in March of 2025 before the tariff sell-offs, and then 2 other times it surpassed that slightly but can't hold it for more than a couple of days to maybe 4 days. It looks like maybe they're trying to cross back above that today. Yesterday, it looks like they surpassed that breakout, and today they're trying to as well, but there is a long upper tail, which means there's some selling pressure today. So we'll see if they can hold that. So if I'm looking at this from a risk to reward ratio, I don't see much reward here, at least in the short term, because it can't seem to break out and hold anything above 30 or so, up to about 37, at least over the last couple of years. But I do see some downside down to the 50-day would be minus 10%. If you hit the 200-day, you're down 23%. It looks like it gets below that 200-day quite frequently over the past year. Over the last couple of years it spent a lot of 2024 under its 200-day moving average. So I saw that you were in at $10, so you've made a lot of money on this one so far, and it looks like you've probably held it for uh, at least since 2023 if you were in at that price. So I'm wondering about opportunity cost at this point when I look at the charts. I don't see a high reward to risk ratio here. That's just my personal opinion. Their RSI is barely above the midpoint at 60. PPO did move into positive territory, which it did at the end of August. Didn't last very long. They had a really great run back in January to March. Money flow is positive. They did have a lot of distribution this year, and it looks like it's maybe getting ready to get back up to that peak. So that's a little bit of good news. There is positive money flow, but when there's negative money flow, it seems to last quite a long time. Let me go back a few more years just to see. Yeah, it seems to spend most of its time in distribution. So that's more on the risk side. They have outperformed the S&P 500 by 57% over the past year, and it's basically because of this big run they've had here. Technology by 49%. Semiconductor, they're outperforming by 26% in the semiconductor area is outperforming the S&P 500 by 24%. I have some questions on this one, Victor. I'm looking forward to seeing the fundamental analysis you're going to do.
Yeah. So this one here is this one, the drop in revenue is concerning. So I'm actually going to go to their investors page and see if I can dig out something else that tells me what's going on here. Because top line revenue to me, what's the momentum of the company? Are they continuing to expand or are they contracting? Contraction would be really, really bad. And that loss of momentum is concerning. I have to explain that. And then the free cash flow, like they had a big necessity to put a lot of capital back into their production, I imagine. That kind of took away a lot of free cash. So when I look at evaluation, I'm going to look at their 2024 number. That's a clean number, but I'm only going to take 75% of it as a starting point and then build a forecast on that. This may be a little optimistic, but I think it's the most realistic forecast I could put together. Okay. Their discount rate is 8.5%. I think that's reasonable. They're a small company. They are at risk. If you have a slowdown in semiconductor, these guys are going to hurt for a while. Their growth rate on cash flow is going to be 15%, and then long-term growth rate of 4%. So I get to a valuation of this company's worth based on cash flows, add cash, take away debt, 1.6 billion. And that's 16% higher. Their stock price is 16% above where they would be valued based on cash. Their earnings per share is very good. And based on earnings per share, if you value the business, which is what most analysts do, it's actually discounted by 53%. So it looks good from an earnings per share perspective. So combined, it's a 21% discount. It's like you were saying, there's not a lot of upside potential. I think the risk reward isn't there. And it's not like a name that you can go to sleep at night and just be like, hey, it's the leader of the pack. The leader of the pack is ASML, right? These guys are like a huge company, and they're number one. Everybody knows that. And their risk reward is, in my opinion, better because they offer you a similar discount, but it's ASML. These guys are gigantic. They're not going to go anywhere. And these guys are small. If there's a sell off in semiconductor, the sell off is going to be most severe in small caps. So that's my analysis there. It would not be a buy for me. It would be a, I'll watch it. If you offered me a 50% discount, maybe I'll pay attention, but not 21. Now let's take a look at their website one more time. I think it's right here. And I'd like to look at their investor page. And here it is. And I'd like to look at their last earnings and see what's going on with their revenue. Also validate, what's going on with their capital if I can. So here's revenues. This is for 3 months. And yeah, their revenue didn't expand a ton. It went 202 to 215, which isn't very high growth. That's 13 million. So that's like 6% growth. That's a slowdown. For the 6 months, again, we're seeing that slowdown. We're only growing what looks to be $33 million, which is less than 10% growth, while this business was growing much higher. So ACM is maintaining revenue guidance of 850 to 950 for fiscal year 2025. Okay, so let's take the midpoint. That would be 900 million. Let me note that. All right, let me keep going. I'm going to get some more information. Yep, this is their growth rate. This is concerning, but let's move on. So balance sheet looks fine. They have good cash balance. We talked about the revenue, and they're not showing the statement of cash flows. Okay. Let's look at the balance sheet. Might tell me what they're putting in their factory. So here's their assets. So inventories, plant property and equipment. So this line is increasing, and depreciation brings that balance down. So if I could get to like how much capital they're deploying by seeing the difference here, which is about 21 million, and then adding the depreciation that they are taking on their income statement. So this one here is just I think they've had a very good run, and I think the stock is priced, with I think all things semiconductor are being pushed higher. Nvidia did have kind of a rough week or two where the stock actually came down a little bit, but still the most valuable company in the stock market. And Broadcom's just been on a tear. And semiconductor as a industry, as a sector, has just gotten a lot of tailwind. And I think this one's gotten plenty of tailwind. So that's my research evaluation conclusion on AMR. Hope you found it interesting. Thanks for asking, Andre. I think it's Andrea, excuse me. Thank you very much for asking, for the super chat. I hope you found it interesting. All right. So So we got, yeah, insane on Adobe. Software companies. I mean, we're seeing it with Salesforce, we're seeing it in certain places, but I just have to I believe that it's gonna rise over the long haul. And one more comment on TTD. It could. If they start growing, that stock's gonna move. I think it'd be a good opportunity if they can figure out how to grow. I agree with you. Yeah. And that one's a good one to watch, TTD, because once they start making that turn, that's when you wanna buy, because then the market's gonna realize it and start buying it. Yeah, I agree. It's, not the, company we just looked at was not a software company. It's um, a semiconductor, equipment company. Yeah, most definitely the AI revolution and the semiconductor demand is causing greater demand, but we're seeing their real revenue on their income statement come down. That's what's concerning me. And, you can't argue with their own financial statements telling us, "Hey, we're slowing down." And that slowdown may be their machines. It's not like you're buying their machines every day, every week. No, you probably buy their machine once in the last 10 years. And then 10 years from now, you order another one. So you may see a big jump in sales, and then all the semiconductor foundries have the equipment they need from ACM. And they're like, hey, we don't need to buy anything from you for a while. And that's when you see their revenues decline. So that might be kind of like their demand cycle. Again, thanks for asking about that business. It's very interesting. I'd never heard of that business. All right, more chatter on Adobe. Nicely done. Okay. A little chatter on Dave. Dave was doing quite well yesterday. What's going on today? All right, keep it going. 17% over the 5 day. Yeah, that'll work. Yeah, great week for Dave. Yeah, and this company, I think it's going to go places because companies that are grabbing a part of the market with a new better way of engaging customers within their space, which is financial services, they're going to win. Because I mean, I don't think people are in love with their banks. It's not fun to go to the bank. It's kind of like the worst experience is the DMV. They're going to make a show out of that, by the way, where people go to the DMV. It's going to be a comedy. You go to the DMV, that's like, oh, I'd rather go to the dentist and get a root canal. And then something that wouldn't be as bad, but still isn't pleasant is going to the bank. Like, oh, got to stand in line, do things like we've been doing them for 100 years, if not longer. Well, Dave is like, yeah, we're not going to put you through any of that. We're going to adapt to everything, the experiences that you are accustomed to and what you would expect out of a modern financial services company. I really like that. It's working for Robinhood and other companies, and I think Dave could grow from a $3 billion market cap up to a more substantial market cap. And they're discounted. So go Dave. Man, a lot of comments. Thanks, everybody. So Ryan H, thanks for becoming a new member. Fix versus IESC. So this is so make sure I got this right. So Fix versus IESC. IESC Fix. So Comfort Systems USA, together with its subsidiaries, provides mechanical and electrical installation, renovation, maintenance, repair, replacement services for mechanical and electrical services. Whenever I see mechanical, I did work with a company. It's been a while. This is air conditioning. This is air handling. So you look at like a big industrial or a big office building. When they refer to mechanical, it's the air conditioning, ventilation, circulation system. So heating, ventilation, so forth, air conditioning. Yep. So that's what they do. Do they have a product or what's their thing? Or are they just services? So they are. So it looks like this is actually their equipment. They most definitely do installations, but they're selling a system to do that. Okay. All right. So that's what they do. And let's take a look at these guys. So designs, installs. So these guys are more in the data center. So they're doing communications, infrastructure within data centers and co-locations. Okay. So these guys are probably busy with data centers. 138%. Comfort Systems. So they're both doing really well. All right. So they're both up over 100%. Let's take a look at each one at a time. So market cap 26.7 billion, revenue 7.6, PEs 39.31, small dividend. So they are growing nicely. They've been growing for a while. So these guys are busy. And let's take a look at their margins and free cash flow. Their cash flow has expanded nicely. Gross margins are really low, 22%. We were looking at software at 80%. Profit, 9%. Free cash flow margin, 7.3. So these are like I think they are in the industrial sector. And these low margins is usually what kind of pushes me away. I'm like, oh, man, I don't want to own businesses that only make 22% gross margins. But we'll do a quick valuation on this one and as well as the other one. 3 analysts cover it. They think it's a little expensive. It might be a lot expensive. We'll take a look. And this one here, I think the margins are going to be similar. Yeah, 25%. They did expand their margins. I guess the demand is so high. They have some pricing power, so they can command a better price. And they did expand their profit, but it's still relatively low. I like, the perfect company makes 90% gross margins, 35% profit margins, really high free cash flow yields of 25 to 35%. And they're growing top line by 50%. That's like, oh man, get me more shares of that company if they're priced right. But these low margin businesses may have a couple good years, but it's hard for them to continue to just become more and more valuable, like a NVIDIA or a Meta or a Google Alphabet, because they just don't compound their market cap year after year after year, decade after decade. They tend to be dragged down by the cost of their business of operating. That's why their margins are so low. They have to pay a lot of people to do the work. They have to pay for materials that go into their systems and so forth. So I could do a quick analysis. I don't know if you have any charts to show on these companies while I do that work, or I could just do it in front of the audience here.
Sure. We can look at a chart real quick.
All right.
They broke out of a long-term topping pattern here in 2021, and they broke out in about June or so of that year, and they haven't really looked back since. They were $51 a share, and now they're trading at $374. So that was a nice run. And they haven't tested, with the exception of the tariff disruption, they haven't tested a 200-day moving average since 20th of December. They have an upsloping. Let me go to 1 year now. It's a little easier to see the trend lines. So they do have an upward sloping 20-day, 50-day, and 200-day. They are getting a bit extended from that 200-day. That usually results in some kind of a pullback. So that'd be they're about 48% extended from the 200-day moving average. They do have a positive RSI sitting at 61 right now. With the exception of just a couple of weeks in August, it's been positive since the 30th of April. One of the things that I'm seeing here, which may support my thought about being so extended from this 200-day moving average, they have an upward sloping price action. But if we look at the RSI and the PPO, those are negative. So that's a negative divergence, and that can happen for quite a while, but that's somewhat of gravity to the price. That can be resolved over time or by a pullback. So that's one thing that I see that I would keep an eye on. Their relative strength and momentum is better than that of the S&P 500. Accumulation looks to be at a 52-week high, and they've outperformed the S&P 500 by 102%, the industrial group by 99%, and let's see, they're in heavy construction. They've outperformed that industry group by 62%, and that industry group has outperformed the S&P 500 by 24%. So we can take a look at FIX real quick, and it looks kind of similar. They've had a great run since their April lows, up about 161%. This one doesn't have quite as much divergence because this has been traveling sideways for the last 27 trading days. It did start breaking out again here in the last 3 days or so. So this RSI negative divergence and PPO negative divergence isn't in quite as much play as it was on the other company because the price had not been going up during that time, and the RSI had been coming back in, between 30 and 70, so not overbought condition. So this is one where just trading sideways for a while can bring you out of that overbought condition. Similar to the other company, they've got accumulation at a 52-week high. They've outperformed the S&P 500 by a little less than the other company. This one's at 90%. The industrial group by 87%. And they're in business support services, so a different industry group. They've outperformed that industry group by 150%. And that industry group overall has underperformed the S&P 500 by almost 30%.
Thank you. And I'm putting the finishing touches on the second valuation. Give me a moment and I'll be right back to you. Okay. So, all right. Okay. Let's look at Comfort and IESC. They're both industrial stocks. I took their trailing 12 months and then I'm growing it by 10%. They are growing top line revenue. This is a necessity. Like they just continue to need the market continues to need their services. So I'm good with that. I added cash, took away debt once I did a net present value of their free cash flows. Um, and I'm looking at a 45% premium. The stock price is 45% too high based on the net present value of free cash flows. Earnings per share looks better. It's the stock price is 13% too high compared to the value of their earnings per share. And I'm giving them a very optimistic PE of 24. This is industrial stocks don't typically get a 24 PE. They get a 12 and a good one gets an 18. But we'll go with 24 because they are doing well in a lot of ways. They're probably having to do a lot of work in data centers, which is pretty hot right now. But even when I give them kind of a lot of optimism, I'm still dealing with the stock that's 34% too high on comfort systems. So it would not be a buy for me. It would be I'm not touching it. And IESC looks a little better. Overall, it's priced 25% too high. And I think Darrow alluded to that this stock has kind of been going sideways. So it hasn't been increasing in stock price, therefore making the premium even higher. But these guys, when I forecast their cash flows,
Is this fixed or IES?
this is IES. Did I have it backwards?
Yeah, I think so.
Okay. So I have it backwards. So
Fix has been going sideways.
delete the comment that I made earlier. I'll come back to Daryl's analysis.
Yeah, IESC is still definitely on an upward trend.
These guys are priced better. It's a 25% premium. If you look at their stock price, 374, but the value of the stock is 280. If I look at free cash flows as well as earnings per share, and these businesses are doing well now. Is this rational in my mind? Right? Yes, because these are good companies, but it's an industrial, right? Engineering, construction. I've known of this industry for 30 years. It's a good industry. And this is like their best. This is their best years ever. This is what it typically does. Okay. This is what I expect out of industrial. And it's doing this. So I'm cautious not to take it's kind of like COVID, right? It happens once every 100 years. Well, am I going to like take all the precautions around COVID? Not anymore. We got that big pandemic out of the way, and 96 years or 95 years later, we'll have to deal with another one because it happens every 100 years. And in industrials like these, they're having an awesome year, but I don't think this is going to continue. It's just not an industry that can sustain this type of growth and stability at these levels. At some point, especially with like all the job losses we're seeing and stuff, this is probably going to settle down. Both of these stocks are probably going to settle down because if we look at the charts, they're both having like, wow, man, we've never seen these conditions ever. So our stock prices are just going through the roof. And these usually don't end well. It'll come back down to $100 a share or something. And investors will go through a long trail of tears. That's my opinion. Doing my research here, and I'm taking forecasts based on these are the best years they've ever had, and I'm even forecasting that they're going to keep it going into the future. If there's any pause to their business, it just breaks this and it's even worse. It's priced way too high. At this point, with a forecast that's optimistic, they're priced too high. So that's my research and valuations on FIX and IESC. Thanks for asking about these, Ryan. Thanks for being a member. And man, we got a lot of comments coming in today. Should have drank another cup of coffee before we started. All right, so let's keep going here. We've got. Let me make a quick note. All right, so market, what's it doing? All right, well, we're back to some stocks are doing great, and some stocks are doing poorly, and you got to pick the right ones. It looks like United Healthcare is up nicely. That's good to see. And Apple's up. What do you think of Apple's they have their big annual product event?
Yeah, on the 9th.
What do you think generally about that?
I didn't see anything that excites me as far as owning the stock right now. I sold out in January. They're being punished a bit this year just because of their AI strategy doesn't appear to be solid at this point. I don't ever count Apple out, but the market is definitely not rewarding them as much as they would if they had a solid AI plan that was communicated. The one thing that I thought was very interesting, I've been retired for 5 years, but I work for a Finnish company, so I traveled to Finland a lot. And it would have been great to have some AirPods back in the day that would automatically translate the language for me. And
Now we're
that was
talking.
yeah, that was one of the features that they announced for the new
Isn't that like
AirPods.
in the UN, United Nations?
Yep,
They
exactly.
usually have like a little headset
Yep,
and the speaker's speaking whatever language they're in, and
yep,
everybody else is hearing it in their language.
yep. So
That
that
would
was
be
kind of
cool.
interesting, yeah.
That would be cool, by the way, if we had earpods that would do that. And one thing that, I've been kind of a bear on Apple for a while. And the main reason is because, they got to where they're at by being innovative. The iPhone, certain products, their culture has been that, they're the ones that were always like the coolest product in the business. Even going back to the original Macintosh and the original Apple computer, their computers were way more expensive, but they were easier to use. You could see that they just had a better look to them. iPhone, when it came out, it was a tablet-based experience. They really did, break the market and took it away from BlackBerry. I don't see that anymore. And I think part of it is their founder is deceased now. And I think that culture of relentless pursuit of the impossible is gone. I think uh, Steve Jobs was, in a lot of ways, a really unusual guy that was relentless in trying to do things that were impossible. And when he tried to do that, sometimes it worked, and the company benefited big time from it. Well, they don't have somebody like that anymore. They don't have that culture. I think they've been kind of just getting by. And if they don't watch it, they could become the next Hewlett Packard. Um, 40 years ago, Hewlett Packard was super cool. You remember the Hewlett Packard calculators?
Let me see here.
You
See
got
that?
all right. You know exactly what I'm talking about.
Yeah, it sits
Hewlett
right.
Packard was super cool. They were like smart. They were like respected. And then they got hooked on this printer business, and they got hooked on PCs, laptops, and next thing you know, they're just completely irrelevant. Their market cap's like closer to zero than anything. if Apple doesn't watch it, they're going to become the next HP, and it'll be a bad thing for investors. So somebody asked about ADMA. I'm not invested in ADMA. I think it generally is discounted. The stock has been losing uh, quite a bit, and it's not having a good 5-day, month, year to date, or year. And these guys here, I think in general, what kept me away from these guys? I mean, they're growing really well, but this quarter, see, whenever you have a business is growing, 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 and then boom, goes off a cliff, like the growth just really slows down. That's like, whoa, hold on a second. Why? What's going on? Like, is there a competitor that's doing something that's better? Or is their drug or their treatment not working? There's something there that has to be explained. So that would be my big cautionary topic on that. If they can grow, we're good. And these here are really good ideas, but you got to pick the right ones. So I'm not in ADMA. I don't know who is. I would just put that caution out there, explain why they stopped growing so fast, and understand how they're going to begin to grow faster. Really important. So, all right. Good to see you, Big House, Big Ben 10. Man, Dave, I'm glad I'm in it. I don't have a ton of capital in it, but I'm in it. UNH. Man, I've seen UNH in the comments a few times. I told myself, because I bring up UNH, geez, too many times. I told myself, don't bring it up. People are tired of hearing about UNH. But it's been brought up a few times. What do you think of UNH? What's going on? What's your feeling about United Healthcare?
Yeah, we've talked about this one numerous times. I have a chart pulled up.
Oh, beautiful.
So I'll show you what I drew 2 or 3 weeks ago when we talked about it. I put this blue dotted downtrend line connecting the high from April and this other high that we had in July.
Mm-hmm.
And basically, what I was saying is we need to watch for a breakthrough above that trend line. I love to see these,
Mm-hmm.
and you can see what it's done since then. On this day, when it jumped 12%, 11.98%, that's the day we learned about the hedge funds and other big companies like Berkshire had been buying in the second quarter. We talked about it the day before that. Uh, yes, the day before that. So they're riding above a 5-day average. Their 20-day is turned around very solidly. I have this green and red line here as an auto resistance line. That's where I had my price that I expected it to come back and touch these levels, and that would be where I entered in some more shares. I said this was the jump. This is where we learned about the 13F filings. We talked about it in a live stream on this day, the day before, and it had already broken out above that trend line. Okay, so then this week they had two pieces of good news. They reaffirmed their guidance, and then the next day they put out a press release that they had 78% of their Medicare plans 4 stars or above, which indicates that they'll receive additional bonuses from the federal government for Medicare plans if they can get those plans into 4 stars or above. So on those 2 days, we saw a price higher, and I don't know what's driving it higher today, but I know CNC, which is another one. They reaffirmed their full year guidance, yes, 2 days ago. So they had a big jump of 8%. It was as high as 12%. And that
Mhm.
helped the other healthcare providers as well. So
Let me
UNH looks very good. I don't see any resistance prior to the 200-day moving average, which is still 16% away.
All right. So let me share. So this is the Datarama. This is their famous super investor website, tracks all these, institutional investors, and they track the top buys in the quarter. And these are big, massive companies. Number one, United Healthcare. So the smart money is buying United Healthcare. On here is Amazon, Alphabet, right? The usual suspects. These are huge companies. Capital One's in there too, but United Healthcare, number one. So a lot of institutional investors are in, and these guys don't usually go in and get out. They're usually like, hey, this thing's going to work, and they're in it for at least a couple of quarters, if not a couple of years, especially like Berkshire, right? They got in it, and they're probably going to be in it for a while. And United Health is still sitting at a 28% discount, and that's after the nice run up. I think this stock is really going to rise back to $600 a share over the next year, 2 years, and go back to where it was. I think the stock market is irrational when it comes to United Healthcare. It overplayed what were negative stories for sure. You don't get CEOs assassinated every year, geez, I've never heard of that ever. So for that to happen, yeah, it's bad news, but it was like bad news after bad news. And the market just got away from this stock like it was just collapsing. And that wasn't the case. So I think this thing's going to continue to work. And I'm really, really glad that they're rising. So we'll see how it goes, but that's one that is a good one. All right. So we got so many comments today. Thanks, everybody. All right. So Ben 10, good to see you. All right. It's cool. I'm going to kind of scan because we got a lot of comments and see if I could pick out. Okay. Here's a question. So Zim has been a stock that has really been something over the last 5 years because shipping has really seen kind of like just really incredible periods. Like when shipping rates were really high, these guys got up to $84 a share. They were giving dividends of like 60% of the share price. It was freaking nuts. But over the last year, not that great. And they are, wow, look at that dividend yield. That's crazy. 49%. I'm not in Zim stock. I'm not a big dividend investor, but anytime I look at Zim, it's going to be discounted. But the market doesn't really care about valuations when it comes to shipping. It's all about what's expected in the shipping industry. Are shipping rates going up, going down? What are the volumes going to do? Are they going to go up, go down? And boy, that's been hard to determine and have a really logical forecast on that because of tariffs and this and the other. It makes it hard. But I'll show my Zim valuation. It's going to be discounted, but that's not how I make decisions on Zim. It's just too unpredictable of a stock. I'm not in it. I don't think I'm going to get in it. Do you have any comments on Zim?
I've lost a lot of money on Zim.
And do you have any charts on it or?
Oh, we could look at charts, but you pretty much just showed them there. Let me see.
That's cool. That's cool. We
You,
can kind of.
yeah, you really have to watch the like you said, what are the shipping charges and tariffs are slowing things down. So these are some challenging stocks to trade.
I mean, if you look at the fundamentals, right? If you look at the money they make and the cash flows, this thing's like 72% discounted. The market doesn't care. They're like, if there's if the Suez Canal were to all of a sudden be blocked again, Zim stock's going to fly through the roof because the shipping routes are going to have to change immediately, and they're going to be able to charge more and have better revenues and so forth. So that's the kind of stock that Zim is. Not my cup of tea. I'd like more predictability. I don't want it to be based on news and situations. My stock is going to go up or down. Good to see you, Falls Grave. Shadow Guy. All right. Good luck on Adobe. What is Adobe doing? So the one stock that I did want to ask you about, I was very curious, is Nova Nordist. Do you have any charts in Nova Nordist? I'd really like to get your 2 cents on that.
Okay. Looks like they reached their high in 25th of June, 2024. And they've been in a downcline since then. They hit a low in August that hadn't been seen since November of 2022. Let's go to 1 year. And you have a downsloping 200, a downsloping 50. The 20 did roll over and is upward momentum at the moment. A lot of volume here since the last part of July. It looks like the average volume probably not quite a double, but it's definitely a lot higher. Their RSI is sitting below 50. Their PPO is in negative territory. Accumulation is basically moved into distribution mode on the 25th. Underperforming the S&P, underperforming healthcare, underperforming their industry group, and the industry group is underperforming.
Mm-hmm.
So unless you are a long-term investor, this would not be something I'd be interested in at the moment.
Yeah, thanks for sharing that opinion. I wanted to hear it. I'm cautiously investing in Nova Nordist. Their valuation is very good, but like you just stated, investors are not having it. So how much lower is it going to go? I don't know. But boy, this thing really rocked up high. And their business continues to grow. So we'll see if it comes back. But I think it might be a while. It's not going to be like United Healthcare. So we'll see. They do pay a nice dividend. It keeps getting better as the stock price sells off. Today it's having a decent day. 5-day, not so good. 1 month, pretty good. Year to date, not good. So we'll see. I'll keep at it with Nova Nordist, just keeping an eye on it because it is a really good company and their fundamentals look great. So we'll see how they do. So somebody who's interested in Palo Alto. Palo Alto is flat today, but I think it's been doing well recently. Over the 1 month, up 17%. This is a cybersecurity software company. And I think at one time they used to be a network company too, but mostly cyber now. So this is a pretty solid stock. What's my value on this? I know I have it. So So I think it's fairly priced. It's just priced a tiny bit too expensive. But if you like the business, this is a solid company, really well-known name, and based on cash flows, it's discounted. If they can improve their earnings per share, they'd be right there. Um, right now, my favorite cyber play is Fortinet. I think it provides the best risk reward situation. It provides a nice discount, and we'll see if it works for me. I think Fortinet's around here somewhere. There it is, 35% discount. And Palo Alto is having a good 30 days, but it hasn't had a great year. 15.9. And look at that. Look at these sell-offs. This is good news for us because we can then buy it at really nice discounts. And now it's, rallying up nicely. Hopefully it continues to go up for the sake of the investors that are in it. It has been a really nice 5-year stock. So it looks really good. So good luck with Palo Alto. So SoFi, I've looked at SoFi probably for the last year. I'm not an investor in SoFi, but SoFi, I think the story on SoFi is what a lot of investors like, which is forget the banks. They're a big, giant pain in the neck. Come to SoFi. And right now I have them at like a premium of 20%. And I think it's because the stock has done well. And I know the investors that are in SoFi really agree with the company's mission, their strategy, and I get it. Um, I decided to invest in like Robinhood and other stocks and kind of didn't go into SoFi. That was my preference. But everybody who went into SoFi, congratulations, you're up 255. I don't see a reason to sell because it's still a $31 billion market cap, which is relatively small. They can keep getting bigger, bigger, bigger. And that stock could continue to go up because their valuation is going to change for the better. As they become bigger, they make more money, they just become more valuable. So I think it's a good stock, very good stock. I picked my lane. I picked Coinbase, Robinhood. I'm doing just fine with those. I'm killing it with those. And other investors on this channel pick SoFi, and they really like SoFi. Congratulations. I'm happy for all of you that are invested in SoFi. All right. So let's go ahead and shut it down because I've got to get going. We've been going for almost 2 hours. It's been a good stream, a lot of good questions, and really appreciate it.
Appreciate all the questions, everyone.
Yeah. And it looks like somebody thinks AstraZeneca is a little better than Novo Nordisk. Thanks for that. Shout out for AstraZeneca. Plane is landing. Thanks, Shadow Guy. So, so let's go ahead and conclude. Any departing thoughts? Anything going on with your channel worth mentioning?
No, nothing really other than these live streams this week.
Excellent. So let's plan on doing some more earnings calls. I had an earnings call yesterday, and I kind of put it together last minute on Adobe, and man, it was well attended. And so so was the Kroger. Nice, good, boring food retailer.
Mm-hmm.
A lot of people joined, and I kind of put that one together last minute. So maybe we can, and I know the ones that you and I have done, the watch parties for earnings have been really well attended. So let's keep an eye out for the next earnings calls, and let's see if we can plan to co-host those sessions.
Yeah, a couple of other things that you sparked my memory on is the buyback window will be closing here probably within the next week or so in preparation for earnings starting again. So that's going to be a fairly sizable buyer in the market that's not going to be participating as much. That's usually a rolling window. It's not like the window closes for everyone. It's like 2 weeks before until the day after that window for each company. But beginning in October, we're going to start seeing a surge of companies. So a big buyer of stocks is going to be pulled out of the market. We're also coming up to the end of quarter, which means ETF owners, big hedge funds, they start doing their rebalancing towards the end of this month. So keep an eye out for that. Things could get kind of crazy here towards the end of the month.
Yeah, very good to know. Thanks, Daryl. All right, everybody, have a good day. Good luck with your stocks today. And then we'll have live streams next week. Hopefully you can join us. Probably the same schedule, Monday, Wednesday, Friday with Daryl. And we'll see where we can mix in a couple of extras, maybe on an earnings call or two.
Okay. Everyone can unbuckle their seatbelts now.
Yep. All right. Have a good one. Have a nice
All
weekend,
right.
everyone.
Take care, everyone.